Welcome to your personalized deep dive, everybody. We have a really interesting collection of topics to unpack today. From what I see in the sources you shared, it looks like we'll be exploring the intersection of global finance, the world of cryptocurrency, and the really fascinating frontier of AI.
Yeah, definitely a lot to cover. And our mission today is to distill the most important takeaways from all of this material. I want to make sure that we connect the dots in a way that makes sense for you, the learner, and highlight what truly matters, all without overwhelming you with unnecessary complexity. And I think, based on the sources you've been reading, we'll be looking specifically at new tariffs and the ever-changing world of crypto regulation. Oh, and how can we forget the exciting possibilities of tokenizing real-world assets? Definitely a lot of hot topics there.
Definitely. And as always, we're going to be doing this in a way that sparks those aha moments. You know, those moments where you're like, oh, wow, I didn't know that, but in a way that you can actually understand. So, without further ado, let's dive right in, shall we? Starting off with the elephant in the room. These new tariffs coming out of the U.S. April 2nd is the date they're set to be implemented, and some are even calling it Liberation Day. Pretty strong wording, wouldn't you say? What's your take on the initial reactions to this news?
You know, it's fascinating. We're already seeing a bit of a split in how people are responding. It kind of reminds me of previous policy decisions where some folks see this as a positive step, way to level the playing field, maybe give domestic industries a boost. But on the other hand, you have businesses who rely on imported goods, and they're naturally concerned about potential cost increases and disruptions to their supply chains. It's like this age-old debate between economic protectionism and free trade is playing out all over again, and we're seeing those same arguments emerge here.
Yeah. I see what you mean. It's like history repeating itself in a way. Okay, so we've got this big economic shift potentially on the horizon. What kind of ripple effects should we be keeping an eye on, especially when it comes to cryptocurrency prices? Everyone wants to know, will this make Bitcoin go up or down?
Well, if I had a crystal ball, I'd be a very rich man. But seriously, the truth is it's really hard to say for sure, and anyone who tells you otherwise is probably just guessing. It's possible we'll see investors flock to assets that are considered safe havens, and some people do put certain cryptocurrencies in that category, so that could potentially push prices up. But then again, if these tariffs lead to broader economic anxiety, we could see a risk-off sentiment across the board. And that would likely include crypto, which could lead to falling prices. So yeah, short-term volatility seems almost inevitable. But the real key will be watching how the mainstream media portrays this whole situation. Are they going to spin this as a positive thing or a negative thing? Because honestly, that narrative can have a huge impact on market sentiment.
Absolutely. Media narratives can really move the needle, that's for sure. So apart from just the crypto markets, are there any other indicators we should be paying attention to that might give us a clue about the broader economic impact of these tariffs?
Well, if you want to understand the big picture, a good place to start is with the Bureau of Labor Statistics. They release reports on all sorts of important economic data, like the overall economic outlook, job market conditions, and of course, inflation numbers. Those are all going to be super important to watch. And then, of course, we have the FOMC, the Federal Open Market Committee, and their interest rate decisions. The crypto market, and the broader economy for that matter, are pretty sensitive to interest rate changes.
Yeah, the FOMC, every word they say gets analyzed like it's the Dead Sea Scrolls. I also remember seeing something about significant investment flowing into the U.S. lately.
Right. That's another interesting wrinkle in all of this. The U.S. has seen a lot of investment recently, something like $4 trillion. And get this, a big chunk of that is coming from the UAE. So you have this backdrop of strong financial inflows, which could potentially soften the blow of any negative consequences from these tariffs. It just adds another layer of complexity to the whole picture.
Definitely a lot to consider. All right, let's switch gears a bit and talk about something that's been making headlines in the crypto world, Tornado Cash. For those who may not be familiar, this is a privacy-enhancing tool for cryptocurrency transactions. And here's the interesting part. The sanctions that were in place have actually been lifted. Huge news.
It is, absolutely. For anyone concerned about privacy in the cryptocurrency space, this is a very big deal, especially in communities that revolve around privacy-focused coins like Monero, Zano, Zcash. And even outside the crypto world, cybersecurity professionals who value digital anonymity are seeing this as a win.
But it's not all sunshine and roses, is it? I mean, there are still some lingering concerns, especially for developers who were caught up in this whole thing, like Roman Storm, for example. As I understand it, he's still facing some legal challenges in the U.S., right?
Yeah, you're absolutely right. While the lifting of the sanctions is a major victory, there are still individual cases that need to be resolved. And Roman Storm's situation is a prime example. The legal strategy being discussed right now involves potentially mooting the case.
Mooting. That sounds kind of technical. What exactly does that mean?
In simple terms, mooting a case means it basically loses its practical significance because the core issue has been resolved. It's like arguing about which movie to watch, and then someone says, hey, let's just order pizza instead. The whole debate becomes irrelevant.
So in this case, the reason for the legal action against Roman Storm is no longer valid because the sanctions have been lifted.
Precisely. And that could potentially lead to his release. But here's the catch. Simply mooting the case doesn't necessarily set a clear legal precedent for future cases. So while it's a good outcome for Roman Storm, it doesn't fully resolve the broader legal questions about things like code as speech. Are developers responsible for how their technology is used? Those questions could still be revisited down the road.
Right, so it's more like a temporary fix than a permanent solution. And I recall reading something about Coinbase's legal team having a strong opinion on this whole issue.
Yeah, that's right. Paul Grewal, Coinbase's chief legal officer, has been very vocal about this. He's advocating for a judge to actually sanction the case, not just moot it. What that means is that a judge would make a formal ruling on the legal principles involved, which would create much stronger and lasting legal protections for decentralized technology in the future.
I see. So they're pushing for a definitive ruling that would essentially close the book on this whole debate.
Exactly. Because leaving things open-ended just creates more uncertainty and could lead to more legal battles down the road. It really highlights the tension we're seeing between the speed of innovation in the crypto world and the sometimes much slower pace of the legal system. It's a challenge for both sides.
Definitely a complex landscape to navigate. Okay, let's zoom out a bit and see what's happening across the pond. BlackRock, a huge name in the traditional finance world, is dipping its toes into the Bitcoin market in Europe. But instead of launching a traditional exchange-traded fund, or ETF, like we see in the US, they're going with something called an exchange-traded product, an ETP. What's the key difference here, and why does it matter?
Well, it all boils down to the different regulatory environments on each side of the Atlantic. You see, ETFs in the U.S. are regulated by the SEC, the Securities and Exchange Commission, while ETPs in Europe fall under the jurisdiction of different authorities like BaFin in Germany or FINMA in Switzerland. And those differences can have a big impact on how these investment products are structured and the kind of investor protections they offer.
So different countries, different rules of the game, it makes sense. And practically speaking, how do those regulatory differences usually play out? How do ETPs differ from ETFs?
One common difference is that ETPs in Europe are often physically backed by the underlying asset, in this case Bitcoin. So the issuer of the ETP would actually hold the Bitcoin corresponding to the shares of the ETP. It's kind of like holding the real thing, if you will. And they're typically designed to be accessible to a wider range of investors in Europe, both retail and professional.
Okay, so they're aiming for a broader market. And what's the overall feeling about this move by BlackRock? Is it seen as a good thing for Bitcoin and the cryptocurrency market as a whole?
Well, many people believe it's a very positive development. Having a major financial player like BlackRock entering the European Bitcoin market with a regulated product like an ETP could certainly lead to increased demand. And if we take a step back and look at the big picture, it's another sign that Bitcoin is becoming more and more accepted by traditional financial institutions as a legitimate asset class. It just might take different regulatory paths in different regions to get there.
And speaking of access, we've also seen these debates about who gets to participate in these new financial markets. Like in the UK, citizens are facing restrictions on platforms like Binance, even though they see ads for it everywhere. And here in the US, we have those accredited investor rules that can limit who can invest in certain opportunities. It feels like there are still quite a few barriers in place.
You're right. These regional differences in regulation and the concept of accredited investors are creating a bit of a fragmented landscape. And that's where things get tricky, because you have this balancing act between fostering innovation and protecting investors. Different countries are trying to figure out the best way to strike that balance, and that's where we're seeing these different approaches to accessibility.
For sure, it's a constant evolution. Now, shifting gears again, it looks like there's some potentially good news for the crypto community in the US on the regulatory front. Can you tell us more about that?
Yes, there are a couple of developments that are definitely being welcomed by crypto enthusiasts. First, we have the FAIR Act of 2023, which stands for the Fifth Amendment Integrity Restoration Act. The main goal of this act is to protect Bitcoin holders from what some see as overreach by the government. So let's say, hypothetically, the government decides to suddenly seize crypto assets. The FAIR Act would give Bitcoin holders a legal way to fight back and prove that they rightfully own their assets. It's basically a safeguard against arbitrary actions by the government.
So it's all about protecting individual property rights when it comes to digital assets. That makes sense.
Exactly. And then we have another piece of legislation making waves, the Kentucky bill, which is also known as House Bill 701. This one takes a strong stance on self-custody of cryptocurrencies. It basically says, hey, you have the right to hold your own crypto without needing to rely on a third party. But here's a really interesting part. This bill also exempts both mining and staking from being classified as securities under Kentucky law.
Wow, that's a big deal. So in Kentucky, they're explicitly saying that mining and staking aren't subject to the same regulations as traditional securities. And there are also no restrictions on local crypto mining transactions within the state, right?
That's correct. And here's another interesting detail. This bill was actually signed into law by a Democratic governor, which suggests that there might be growing bipartisan support for the crypto industry, at least at the state level. These developments are certainly being seen as positive steps towards a more favorable regulatory environment for crypto in the U.S.
It's quite a contrast to some of the more cautious approaches we've seen from federal regulators, wouldn't you say?
Yeah, for sure. It just goes to show you how diverse the perspectives on this rapidly evolving technology are, and how things can vary so much, even within a single country.
Speaking of evolving, let's turn our attention to the crypto markets themselves. There's been an interesting observation lately that stablecoin volume has been unusually low, even while crypto prices have been climbing. That seems counterintuitive, doesn't it? What could be driving that trend?
It is a bit of a head-scratcher. Normally, you'd expect to see a surge in stablecoin purchases before a big price rally in the crypto market. That's because people often use stablecoins as a way to quickly enter and exit trades. But the fact that prices are going up without that stablecoin activity could point to a shift towards more direct fiat to crypto purchases. Maybe more people are just skipping the stablecoin step altogether and using their traditional currencies to buy crypto directly.
Interesting. So it could be a sign that people are finding it easier and more convenient to directly access the crypto market. Now, what about the world of decentralized exchanges? There was a lot of buzz about PancakeSwap gaining traction recently.
Yeah, that's right. PancakeSwap, which operates on the Binance BNB chain, did see a significant increase in activity recently. And a lot of that can probably be attributed to a large $2 billion investment linked to Binance, which likely fueled user engagement and trading volume on the platform.
But it sounds like the top spot in terms of trading volume has shifted once again.
Correct. As of right now, Uniswap has reclaimed its position as the leading decentralized exchange by volume. These shifts in dominance often happen in the fast-paced world of decentralized finance. Sometimes it's about new features, other times it's about incentive programs, and of course general market sentiment plays a role too. It's a dynamic landscape.
Absolutely. Now let's talk about a truly cutting-edge area. The tokenization of real-world assets. We've been hearing a lot about the Dubai Land Department making some moves in this space. What's the latest on that?
Well, the Dubai Land Department recently announced a pretty ambitious real estate tokenization project. And this is a big deal because it shows that the UAE is really embracing the potential of blockchain technology to transform traditional asset classes. They're looking ahead and trying to figure out how to use this technology to their advantage.
Exciting stuff, but if I'm being honest, the details are still a bit fuzzy, aren't they? We don't know exactly which blockchain they'll be using, what the tokens will look like, or even if it'll be a permissioned or open system.
That's right. The specifics are still under wraps, but it's definitely in line with a broader trend we're seeing. You have other entities like Dar Global Properties partnering with platforms like Mantra Chain to tokenize real estate. The momentum is building, and it's only a matter of time before we see more concrete details emerge.
So for those of us who might not be blockchain wizards, what are the main benefits of taking a physical asset, like a piece of real estate, and turning it into a digital token? What's the point of all this?
Well, tokenization offers some pretty compelling advantages. One of the biggest is that it can make high-value assets much more accessible to everyday investors. For example, with real estate tokenization, you could have fractional ownership, where you own a tiny piece of a property instead of needing to buy the whole thing outright. It's kind of like buying a share of a company instead of the whole company.
Okay, so it's about democratizing access to investments that were previously out of reach for most people. But what about the potential downsides? Things like know your customer, KYC, and anti-money laundering, AML, regulations. How do those play out when you're dealing with transactions on an open blockchain? Doesn't that create a whole new set of challenges?
Absolutely. It's a key consideration, and there are no easy answers. How do you balance the need for transparency and security on a public blockchain with the requirements of KYC and AML regulations, which are often tied to traditional financial systems? One potential solution that's being explored is a hybrid approach.
A hybrid approach, what does that mean in practice?
Basically, you'd have the initial user verification, the KYC part, handle on a centralized platform. So you'd go through that process once to verify your identity, and then once that's done, your ownership of the tokenized asset would be represented on an open, public blockchain, like Polygon, Binance Smart Chain, or Ethereum. This way, you get the benefits of blockchain transparency and transferability, but you also have a degree of control over user identity to comply with regulations.
Interesting. So it's about managing identity in a centralized way, but then letting the assets themselves live on a decentralized ledger, kind of the best of both worlds, potentially. But it doesn't solve everything, right? What about people in countries that are facing international sanctions? That seems like a really tricky regulatory hurdle to overcome.
Yeah, that's a tough one. There are a lot of complexities when it comes to giving people in sanctioned countries access to tokenized assets while still adhering to international law. It's a multifaceted challenge that requires careful consideration from regulators and the industry alike.
For sure. Definitely a lot to unpack there. All right, last but not least, let's touch on the partnership between the Abu Dhabi Global Market, ADGM, and Chainlink. This seems like another important development when it comes to the future of tokenization and how different blockchain networks will interact with each other.
Absolutely. The ADGM, which is a major financial hub in the Middle East, has teamed up with Chainlink, a leader in the world of decentralized oracle networks. Their main focus is going to be on pushing forward the adoption of tokenization and, crucially, making different blockchain systems more interoperable.
And it sounds like they'll be doing this through events, right? Exploring things like proof of reserves and setting industry standards.
It's exactly. They'll be hosting events centered around tokenization and blockchain interoperability and diving deep into the technicalities of proof of reserves, which, by the way, is basically a way for crypto platforms to prove that they actually hold the assets they claim to hold on behalf of their users. It's all about transparency and accountability. Oh, and I have to mention Chainlink's Cross-Chain Interoperability Protocol, or CCIP for short. It's a really innovative piece of technology that's going to be key to this partnership because it basically allows different blockchains to talk to each other and transact seamlessly and securely. Think of it as a universal translator for blockchains.
So as we wrap up this deep dive, you should now have a much clearer picture of how global events like new tariffs, the constantly changing world of crypto regulations, and the groundbreaking potential of asset tokenization are all interconnected.
And it's important to remember that things are moving incredibly fast in this space. Geopolitical events, new regulations, and technological advancements are all constantly shaping the world of digital assets. Staying informed, like you're doing right now by listening to this deep dive, is absolutely crucial.
And as you continue to explore these topics, consider this. What are the long-term implications of traditional financial institutions offering access to Bitcoin through products like ETPs in Europe? How accessible will Bitcoin become in the future? Will it eventually be as easy to buy as stocks or bonds?
And what about the legal battles surrounding privacy-enhancing technologies like Tornado Cash? Will those battles ultimately determine the limits of digital freedom? These are big questions.
And then there's tokenization. What real-world opportunities and potential pitfalls will emerge as we bring more and more physical assets onto the blockchain? This is a powerful technology with the potential to change a lot of things, but it also comes with risks that we need to be mindful of.
This deep dive has been a great starting point, but the exploration doesn't end here. We encourage you to keep digging, keep asking questions, and keep learning.
And we'll be here for your next deep dive, ready to help you navigate the fascinating world of finance, cryptocurrency, and AI. Until then, keep exploring and stay curious.
See you next time.